Good day to you, and welcome to my discussion on accounting for investments. My goal today is to review and maybe learn the accounting for trading and available for sale types of investments. I do these two investments together because they both use a technique that in industry is known as mark-to-market. What this means is at the end of the period, we adjust their balances to fair market value. This is a departure from cost accounting for them at cost. And it's one of the first times we've actually made that. So perhaps you'll find it interesting. It's a relatively new set of rules that relate to this. Let's get started. Let's remind ourselves as we get started with a few different aspects of this. So we'll look at trading and available for sale. First of all, let's talk about how these both are classified before we begin actual entries on the balance sheet. Trading investments are always classified as short-term. The reason for getting into the investment at all was to try to snag a gain. This category is generally used by financial institutions that hold most of their investments in liquid assets, like banks and other institutions like that. Available for sale can be classified on the balance sheet as short-term or long-term. And the difference is really on management's intent. Available for sale is the most common category for businesses that aren't financial institutions. And if management intends to hold the investment only for a short period, it's short-term, or for a longer period, then long-term. Let's review the types of investments you can get into now on trading. Trading securities accounting applies to both stocks and bonds. In my example, I'm going to stick with stocks. And available for sale, the same. Stocks and bonds. Both stocks and bonds are regularly traded on the marketplace. And so market values are readily determined. Therefore, marking them to market at the end of the period is easy. Now that we've done a little bit of review on where they belong on the balance sheet and the types of investments that are involved, let's look at specific accounting techniques for each type. I'm going to do them side by side because they have more in common than they have differences. And I'm going to use a simple example of buying and trading stocks in this Pincast. Let's start at the beginning by examining how you do the accounting for purchasing this investment. In our example, let's assume we purchased 100 shares of stock for $175 a share. Let's look at the journal entry to record this for trading and for available for sale. In both cases, we debit an investment account and credit cash for $17,500, which is 175 times 100. Notice in my entry, I flagged which portfolio I was going into. That may or may not be the case for a business. They will keep track of them in separate portfolios, but for us and our purposes, I am going to show them to you so we can keep track in our minds of which investment we're looking at, since we're doing them side by side. So a simple purchase, debit investments, credit cash, both have the same entry other than we're flagging which portfolio it goes into. So now that we've looked at the purchase of an investment, let's look at how would we record the income that investment earned. Let's assume we received a dividend of $10 per share on each of the shares we purchased above the 100 shares. Again, the entry is the same for trading and available for sale. We debit cash and credit a revenue account. In this case, I used dividend revenue. Stocks pay dividends on a regular basis. It's one of the reasons a business invests in them. So this is the regular type of income you would see from a stock purchase in both the trading and available for sale portfolios. The other thing we said we hoped to gain from purchases of stock was to sell them at a gain. So let's record selling 1/2 of this investment. Let's sell 50 shares, which is 1/2, and let's sell them for $180 per share. Bought them for $175, sold for $180. Buy low, sell high kind of mentality. Wahoo, good deal, huh? And notice again, the entries are very similar. The only difference is I flagged for you in our example which portfolio it was coming from. Cash received would be 50 times $180 per share we sold it for, and that would be increased. Then we would credit the investment account. That would be at cost, 50 times $175. That's what we paid for it for $87.50. The difference is a gain of $250. The only difference between these two entries, again, is I'm keeping track of the portfolio that they're in. So we've looked at the purchase of an investment, the income that that investment made during the period, and then the journal entry to show the sale of part of that investment. We're now down to what adjusting entry you would make at year end. Let's assume that at year end our stock is listed on the various markets at being worth $185 per share. Analysis of the facts show that our cost of this investment, 50 times $175 a share, remember we sold half of them, would be $87.50. And the market value of our stock, we still have 50 and it's being sold currently at 185, would be $92.50. So our stock has had an unrealized gain, that is one we haven't realized yet because we haven't sold it yet, of $500. This is going to require that we make an adjusting entry at the end of the period because remember, we are using mark-to-market accounting here. It's the first time that you've seen this to this degree, so let's see what happens. There is a difference between trading and available for sale. So cost of $87.50, current market value $92.50, leaves us with a gain of $500 that we need to record. Under trading investments, we would debit an account called fair value adjustment. In the amount of $500 and credit an account called unrealized gain. And I'm going to put income statement here because that unrealized gain on a trading investment actually runs through the income statement. Theory here is that you bought this just to realize short-term gains, and so the gain belongs in the period that you actually experienced it. So we're going to run that gain through our income statement and call it an unrealized gain on investments. I flag it with IS income statement here so that you notice where it's going, and it is a trading fair value adjustment. Now let's look at that same entry except for available for sale stock, one that you have the intent to hold. This entry still has a fair value adjustment. This time it's flagged as available for sale in the amount of $500, an unrealized gain in the amount of $500. But this isn't going to go into the income statement, it's going to go into that account we talked about, comprehensive income, on the balance sheet. So the trading investment actually appears on the income statement in the amount of $500, making that income $500 more when it's a trading investment, but when it's available for sale, it appears under owner's equity in comprehensive income, not affecting the income statement at all. Remember, when we got into available for sale, it was to hold it for an undetermined amount of time. It was available for sale, and we'll sell it when the conditions are right. But when it was trading, we were in it for the short term, so it's felt that it's appropriate to recognize that income trading. That's why you got into it. But to recognize that unavailable for sale would just make your net income volatile. You're going to hold this for a while. The market goes up, the market goes down. There's no reason to show that on your income statement because you're only going to sell it once. And when you do, you'll put that gain on the income statement. Drawing a line between our categories, trading and available for sale, and I want to zone in a little bit on how they're going to look on the financial statements. Let's start with trading, and let's look at the income statement. You would have the gain on the sale of the stock. Remember, we sold half of it, and that was a realized gain in the amount of $250. And then we'd pick up the unrealized gain from the year-end adjustment that we made above. It's an adjusting entry for $500. So net income would have been affected from these two items, and I'm only referring to these two items right now, would have gone up for $750. Compare that to what happens on available for sale. The only thing on the income statement for available for sale would be that gain where you actually sold the stock for $250. The unrealized gain does not show up on the income statement. Let's look at the balance sheet now. On the asset side of town, we show our investment at cost, $87.50, and then we show the fair value adjustment. Fair value adjustment is a contra account or an adjunct account, meaning it relates to the investment account and it can make it bigger, in our case for a gain, and it could also make it smaller if it were writing this down to a loss. The important thing to notice is that the investment is shown at market value. We marked it to market. Pretty cool, huh? How about stockholders' equity? Retained earnings went up for the $250 we had on the gain from sale. That would have been closed in retained earnings. And it went up for the comprehensive income fair value adjustment year-end of $500. So retained earnings increased by the total of the two, or $750. We literally recognized that unrealized gain in the amount of $500 on the income statement and then closed it into retained earnings under the trading method. Then available for sale, handling on the asset side of the balance sheet, mirrors what happened on trading. We have the fair value adjustment account being shown against the investment account. So we take and add it to that balance to get $9,250. So once again, the available for sale investment is shown at fair value, mark-to-market accounting. But let's look at what happens on stockholders' equity. That, indeed, is different. The $250 gain we had on sale that was shown on our income statement is naturally closed in retained earnings when we do our closing entries. But the $500 fair value adjustment made with an adjusting entry at the end of the period is closed into an account called comprehensive income. This is the first time we've actually made an entry into the comprehensive income account. And remember, it's a stockholders' equity account. It's shown as part of stockholders' equity, and it holds things that have happened and affected the fair value of the company, but have not been shown on the income statement. With this accounting mark-to-market, it's felt that the fair value of the investment should be shown at what it is, that's good disclosure to potential investors or owners of our business. But since we're not going to sell that investment in the near future, that it should not be shown on the income statement, therefore it can't be recorded into retained earnings. It must be recorded somewhere to make the balance sheet balance, so it goes into a new category for you under stockholders' equity called comprehensive income. Comprehensive income is where we put increases or decreases to income that have not affected net income, or increases or decreases to the value of the business that have not affected or been ran through the income statement. In summary, you could say that the fair value adjustment is included in net income for trading investments. Available for sale securities, the fair value adjustment is not included in the income statement. Rather, it goes into comprehensive income. Our balance sheet has changed a little bit. We've always had assets, we've always had liabilities, and we always have some kind of stockholders' equity. And in the past to this point, it's included paid-in capital accounts, and it's included retained earnings, where net income is always closed into it. It's included treasury stock, if applicable, for the business, and now we have a new section to it called comprehensive income. And this section, can't spell if I write. I don't know how to spell. Sometimes I spell wrong when pen casting. I'm thinking. We have a new section called comprehensive income where we make adjustments. If you have to take any asset to a value other than cost, the change in that asset or perhaps liability is ran through this new account called comprehensive income, and the total of those equals stockholders' equity. You might be interested in a little more of a discussion on comprehensive income. Comprehensive income is used when we need to adjust a balance sheet account to fair market value, but for a variety of reasons we don't want to include that adjustment in net income. It will distort it. Really, there are 4 things that can cause that. The first is unrealized holding gains and losses on investments, like we just learned with trading and available for sale investments. The second is foreign currency transactions. If you denominate in a currency other than dollars, when you make your balance sheets from period to period, there could be some changes in numbers that are caused by nothing but fluctuations in the value of currency. Those are included in comprehensive income. Another category that gets included in comprehensive income is certain types of gains and losses from pension accounting. And lastly, certain deferred gains and losses that come about from accounting for derivatives. The comprehensive income account can be positive, balance, or negative. It can increase owner's equity or it can decrease it. So it can add like an adjunct account, which is what we call an account that increases something, or it can act like a contra account. It can decrease it. So this is an owner's equity account that can be positive or negative depending on the effects of the entries that have been closed into it. It's a balance sheet account and it carries forward. Thanks for joining me for this discussion on accounting for investments in the category of trading and available for sale.